Investment in securities market is subject to market risks. Read all the related documents carefully before investing.
In fact, if you look at the classic investment advice given for building wealth, right? Buy low, sell high, right?
It sounds quite easy, no? Buy low and sell high.
Exactly, right? Common sense suggests that this should be the, what every investor should be following, right? Who, whatever asset classes, they are investing in, so on and so forth. Now, what we have seen is, even though this is the advice, generally it generally happens the other way for most investors.
They buy high and sell
low.
What are you saying? They buy high and sell low.
Sell low.
Why would they do that? Hi there, my name is Saurabh Mukherjea and it is my privilege to welcome you to the 4th episode of Guru Mantra with Saurabh. My company's name is Marcellus Investment Managers and I'm joined by my colleague Krishnan, who runs our investment advisory vertical in Marcellus. Now in the episode so far of Guru Mantra, we've focused on the positive aspects of equity investing. For example, the benefits of long-term compounding. We've also discussed how much of your wealth you should allocate to equities. In this episode, we will discuss the common mistakes and biases that investors have and how these can be dealt with. So Krishna, let me come to you. Right? It's one of the strangest things in investing is that investors tend to be their own worst enemies, right? They tend to do things which are self-damaging, they cause self-harm, right? What are these aspects of self-harm that people cause and how can they be dealt with?
Sure. So I'll start answering that question maybe with that cricketing analogy we left off in the last podcast, if you remember. So many people perceive investing as something involving constant action. Including watching share prices all the time, reacting quickly to news flows, market movements. The general belief is that such active investing yields result in immediate future, right? However, it seldom works like that, right? Because investing is not like a T20 match where you're attempting to hit every ball out of the park. It is more like disc cricket, like we discussed in the last podcast again, where you do not even attempt to play every ball, let alone try to hit every ball to the boundary.
Right, interesting.
Right. In fact, if you look at the classic investment advice given for building wealth, right? Buy low, sell high. Right?
It sounds quite easy, no? Buy low and sell high.
Exactly, right? Common sense suggests that this should be the, what every investor should be following, right? Who, whatever asset classes, they are investing in, so on and so forth. Now, what we have seen is, even though this is the advice, generally it generally happens the other way for most investors.
They buy high and sell
low.
What are you saying? They buy high and sell low.
Sell low.
Why would they do that?
Right. This is due to a combination, again, different reasons, but maybe external noise around the investor, emotional biases of the investors themselves, right? Because all of us are human beings, right? We have our own biases, emotions, etc. And one way to think about this is, in one way this manifests itself is what is known as the fear of missing out, or what is called as FOMO, right? Where, investors fear on missing out on, investing in a stock.
Basically, a stock is running up.
Yes.
When the stock is hitting the sky, people are getting FOMO.
Yes.
They're loading up on the stock when it's already hitting Mount Everest levels.
Exactly. And this leads them to buy overvalued stocks, right? Because they fear on missing out on future prices.
Family mein baat chal rahi hogi, friends are talking about it. Mohalle mein gapshap chal raha hai.
Exactly. Right. So the advice is to buy low, sell high, and you end up incurring losses by doing exactly the reverse, right? In fact, multiple studies done in India and other countries have shown that the returns earned by investors are lower than the returns earned by the fund in which they invest.
Or the stock, right? So basically the stock could be compounding at 20% in the long run, but the investor buys upar and sells niche. So the investor doesn't get 20% even though the company has delivered, share price has delivered 20%. This is fascinating. So part of it, I guess, is this mistiming. Rather than buying low and selling high, they're buying high and selling low. So part of it is that. What else is happening which damages investors' returns?
Yeah, the other problem is the frequent trading, right? Because like I said, right, you essentially you have this, burning desire to do something, and you think that doing something will give you positive returns, will generate positive returns, right? So, in fact, too much trading and chasing returns based on news of the days, again, there is a, one way to think about this is, there's a SEBI report which was published in January 2023, which said that approximately 9 out of 10 traders, right, in equity, futures and option market, they lost money in FY22.
Because the transaction cost depleted their wealth.
Yes. So, not only transaction cost, but again, frequent trading.
Achha.
Right. So, and the study also found that loss-making traders expended an additional 28% of their total realized losses in terms of transaction costs, like brokerages, taxes, etc., etc. Right. So, this is again, the result of both, again, over trading and doing something just for the sake of it. And also, like we discussed, the behavioral aspect, right, where you end up, in most cases, investors tend to buy high.
So what you're saying is, obviously, to make money in the stock market, you need to be patient. कम से कम 5 साल का horizon होना चाहिए. But if you can't be patient, at least don't enter the stock market and do trading. Because if you enter the stock market and do trading, 90% probability, basis SEBI वाला data, 90% probability कि आपका पैसा डूबेगा, and therefore frequent trading is the ill to be avoided. If you can't be patient, आपसे 5 साल अगर धैर्य नहीं रखा जाता, आप stock market में निवेश मत कीजिए. Worst thing to do is coming and entering and doing lots of trading. Now, is there a patient rules-based approach to investing that we can give the viewers of this podcast?
Sure. So, we have a strategy called Meritor Q, which is an advisory offering, from Marcellus, which follows a disciplined rules-based investing approach. And this is an offering which is available to retail investors. The rules, in Meritor Q, they are based on good investing principles and are designed to address risks specific to investing in Indian companies. And the investment objective in Meritor Q, to put it simply, is to invest in good, clean companies with strong balance sheet and which are consistently profitable, right? And to buy them at prices below their intrinsic value, right? And we do this regular, in a very systematic and and we repeat this process, regularly. What we call as rebalancing. This rebalancing happens on fixed dates every year according to the portfolio construction rules. The main advantage of this approach, and again, what makes it very relevant to what we are discussing is this is a completely transparent, rules-based approach, right? And it completely avoids any emotions and biases.
So, अगर election result आया, GDP growth ज़्यादा आया, युद्ध हो गया, you don't get involved in buying and selling. You don't get involved in anything, right?
All we are focused is on buying good companies and staying invested over a long period of time.
So folks, there you have it. Successful investors, successful investing should be about as exciting as watching paint dry, right? Successful investing does not have an excitement quotient. Excitement के लिए there are other things to do in life. Equity investing is about patience. It is by definition meant to be boring. Successful equity investors end up being able to stay invested in the same stocks for long periods of time, at the very least for 5 years. Krishnan has come up with a method for rules-based investing called Meritor Q. If you can adopt the Meritor Q rules, brilliant. But what you shouldn't do is come into the stock market and do lots of buying and selling, because that's a guaranteed destruction of wealth. That's it for us in this episode of the podcast. In the next episode, we will discuss the benefits of a diversified portfolio as opposed to single stock investing. Thank you very much for joining us.